And we're back with Barry Dyke. So college football coaches and banks, you've done a lot of research on banks buying life insurance, which sounds odd. Why would a bank, it is Life Insurance Awareness Month, why would a bank buy life insurance? It's called BOLI, bank-owned life insurance. I also heard a friend that there's something called HOLI now, which is called the hospital-owned life insurance. That's somebody's trying to get off the ground. But BOLI, I mean, we've talked about this before on the show, but for people who don't understand, why would a bank buy life insurance? And are they still doing
Very smart. They're still doing it in a big way. Matter of fact, if I don't know if I can pull this up, I might be able to pick it up. I'll give you some. So, giant banks like, hang on if I can pull this up. Let me see if I can just pull this up. Wait 1 second, Josh. I'll share this with your listeners, but this is all true. This will be in the next book.
Apparently, one of my notes says major European banks, along with Bank of America, Merrill Lynch, UBS, Lloyd's, and others, are continuing to offload their retirement and pension risks to life insurance companies.
So this is a matter of fact. UBS actually bought over $1 billion annuity this year. Actually, Bank of America Merrill Lynch bought one for $500 million to cover like 900 retirees in the UK. Lehman Brothers, folks, hello, that little bank that was the largest corporate bankruptcy of all time. They bought a $1 billion annuity in the UK to retire, and could make this up. But Barclays Bank, some of the other banks were buying them.
But didn't they go under, or is that to just insure their old pension risk?
When Lehman failed in the U.S., they dumped the pension benefits onto the pension BBGC, Pension Benefit Guarantee Corporation, which is kind of lousy, but they did that, and actually they threw another sweetener is where 26,000 people got a 75% subsidy for the health care. I don't know if you ever heard of that one, Josh, but you'll know about it. But in the UK, they have a pension protection fund similar to the PBGC. When that failed, the Lehman Brothers pension failed in the UK, went to the pension protection fund. Then the pension protection fund, who has to rescue these plans, said, "Hey, we're better off by giving us to an insurance company," and that's what they did. So this is all true. You couldn't make it up. But to this day, no one in Bloomberg, CNBC, I was even referred to Fox one time. They won't talk about it, but it's all true.
Now, how are the insurance companies? This is me playing devil's advocate a little bit, but yield is like nothing for these insurance companies now. How are they able to make money in like a 2% Treasury universe?
Well, it's very, very difficult. No doubt that's it. But like last year, and I talked to I know some CEOs of life companies, and they were able to make a killing, Josh, when everything was being when people had to raise cash last March in 2020. They scooped up a lot of good stuff because when you have to raise money, you sell your best stuff first. So
because in March of 2020, a lot of bond funds had to unload good bonds. Nobody wanted them out of the liquidity, and the bond funds bought it. Yeah, I knew that because I knew the guy. I won't tell you, but I knew a guy who did that like 10 years ago when there was that whole taper tantrum, or it might have been 5. I don't know when it was, 5 years ago, 7 years ago, where the bond market was up. The guy made like $5 billion in a day, because everyone wanted to unload these bonds, and they were just buying them up for some solid insurance companies. So,
but they had they're making money in the mortality risk. They have the laws of large numbers, Josh. So they can scale, and the thing is, and rightfully so, the way the insurance policies are designed, or annuities are designed. Your money's there. It's a long-term thing. It's not a thing you go in and out like at a stock. Where so they have some contractual.
And still, you got to consider, even if they're getting 2 to 4%, that's still better than 0 to 1 at the bank.
Yeah, exactly. So give an example. So here, J.P. Morgan Chase, okay, matter of public record, FDIC, as of March of this year. Hang on, was it March of this year? And this will be in the book. Yeah, as of March 31st, they have over $12 billion in cash surrender value on their balance sheet.
Wow.
Bank of America, $22.95 billion. Wells Fargo, $19.36 billion. And this is part of the Tier 1 capital. This is the most important asset in the bank.
The Tier 1
Citibank.
capital reserves.
It's the most important asset. You can talk about, forget about everything. So if you don't know what Tier 1 capital is, but that's the most important thing. PNC Bank, Capital One, TD Bank, Truist, which is the old BB&T SunTrust Bank merger, Bank of New York Mellon, which is amazing. It kind of amazes me because Bank of New York Mellon is essentially an asset management bank, but they have $4.5 billion of their $22 billion of Tier 1 capital invested in life insurance.
Yeah, they're a
First
smart
Republic
bank.
Is another.
Yeah, they also had.
Smart bank.
It was interesting. They were getting involved in. They did something with crypto earlier this year, or something that I forget what. There was something with Bitcoin and them, but I forget the news story there.
But they're a carriage trade wealth management bank is what they do, and they have a huge portion of their own capital invested in it, and First Republic, which is another kind of like Bank of New York wannabe, based out of San Francisco, they have a huge position in it as well. So say what you will. At the end of the day, these banks they see, because they make their money on leverage and fees and things like that. They themselves understand that life companies manage risk better than they do.
Now, as we conclude, what other you talk about 401ks have become the casino for retail investors instead of retirement plans. Any latest research on that area?
Oh, it's a disaster, Josh. It makes me sad. Well, it's only rock and roll, but I like it. Look at it. What we have is go to allianceforlifetimeincome.org. Mick Jagger his tour this fall is sponsored by Alliance for Lifetime Income, which represents the interest of the annuity business, which is it's what is called in Wall Street speak TINA. There is no alternative. So all these guys from Wall Street and all these banks figured out, by the way, people need annuities, and so they want to get into that space in a big way. And unfortunately, what they want to do is essentially cut the Joshes and Barrys out of the world, so they can just keep it all for themselves. So the Alliance for Lifetime Income, it's a very slick website. It's owned. They spend about $37 million a year lobbying, and they're actually sponsoring the Rolling Stones No Filter tour. So this is one of the most important things for people can do. But it's tricky, particularly you're in New York City. It's very difficult in New York, but that's another story.
Yeah, well, thank you so much for coming on again, as always, Barry. And as we conclude, talk about, it's college football season. And folks, if you want Barry's latest book, give us a call, 888-988-JOSH. You'll get the book free when you schedule a 45-minute wealth strategy blueprint session with the Financial Quarterback team. So, Barry, you talk about college football. College football has, for some reason, Dabo Swinney, Jim Harbaugh, any new people, for some reason they like life insurance and annuities. Talk about that.
Well, let's look at. I don't know if you brought this one up, but I kind of when I researched my first book, I didn't realize it, but Comcast, which essentially does a lot of the college football, when Ralph Roberts died in 2016, he had $490 million, 460 million, something ridiculous of life insurance proceeds for his wife Suzanne, I think it was. If people want to email you, I'll
give right here. Comcast pays $490 million to settle Ralph Roberts' life insurance.
So why is one of the biggest media companies in the world buying this? They buying this because it's bad for them? I don't think so. So the whole thing is today. So that's a big one. So you couldn't make it. I don't know who actually would. Obviously, they spread this risk all around, Josh. They had to go all.
The cable television giant also paid $164 million to end insurance policies on Suzanne Roberts' life that were becoming expensive because of her age.
Oh, she had them too. I didn't know that.
She must have had some universal life garbage.
Yeah. But but my point is that why does anyone do that? Because they get it.
And by the way, when we talk about this, you got to mind the fees. You got to watch certain risks, like universal life has rising cost of insurance. Sometimes it's good for people. You got to look at the fees, the prospectus, the company ratings. So we're not, being blind. You got to be critical thinker.
Yeah. Because this is really important. This is very, very important stuff with people. And I, like when you do this stuff, when I do it, I say, like, what would I do? And you and I will see things that the average person won't do. Not that they're not good people.
Yeah, I had a guy the other day. It was sad. The guy thought he bought a whole life, permanent life for his wife to do pension maximization. He put in, I don't know, 25 grand of an old whole life into a universal life, and the universal life's going to blow up when he's like 70. And he could have probably paid a little bit more for a better whole life and not screwed himself. But he didn't know. He wasn't educated properly.
Yeah, so as much as they want to sell us planes with no pilots, I still think people need a pilot when it comes to their financial life. And not everybody, but actually the Guardian did a study, I think released in 2017, Josh, showed that like 70% of the people were better off using advisors than not using an advisor.
Yeah, even by the way, this is interesting. Vanguard did a study on that too, called Vanguard Advisor Alpha, and they found that those who had an advisor using their funds did better than those with no advisor, which was interesting. So.
Yeah, because stuff is pretty dangerous, and you start looking at the ETFs now, and I mean it's just and then these junk bond funds and all this with the stuffing in them, and
you got to be careful, totally. So thank you
really,
so
really
much for coming on board, Barry James Dyke, author of the books Pirates of Manhattan, Pirates of Manhattan 2, and Guaranteed Income, which you get to pick any of those books at no charge when you schedule and keep your no obligation review. Get one free book when you schedule your 45-minute ultimate financial blueprint. Give us a call. 888-988-JOSH, 888-988-JOSH, 888-988-5674. This is Josh Jalinski, Financial Quarterback, signing off.
The preceding program was sponsored by the Jalinski Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.